Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the return of volatility. The market's still on track for a positive week. We discuss and debate the road ahead with the investment committee. Also have plenty of moves to tell you about today. Look forward to doing that. Joining us for the hour, Josh Brown, Carrie Firestone, Malcolm Etheridge, Bill Baruch. Volatility on full display. Really today, we were nicely green. We're still hanging on in the NASDAQ, but the S&P and the Dow have since gone negative. The shutdown rolls on. The trade war rolls on. The Russell is still having its best week since 2024. It's up 5%. We're watching that. It is the largest decliner. Gold, another record high. That's like a broken record, obviously. But Josh, even with this volatility back, it doesn't feel to me as though people are really changing their big picture view. Goldman's Tony Pasquarello today, whom I love to quote, says this remains one of the most dynamic market environments I've ever seen. Looks at the banks as a litmus test on many of the big questions that exist and says, quote, I thought the takeaways from Q3 earnings were very encouraging. And what that does for me is it underscores why people remain bullish, because earnings and the expectations that they are, in fact, even though they've just started, they're going to be encouraging. What do you think?
Yeah, I think that's a really important point that Tony makes and that you raise, and it's a good place to start because when you actually listen to the calls, and I couldn't do all of them this quarter, but I listened to the big ones, it's not as though the banks are telling us they're gangbusters in everything related to AI and capital markets and everything else is moribund. It's the opposite. They're seeing opportunity in every segment of the economy. It's not to say that there aren't problems. There's always problems. But the big picture, according to the banks, is that the consumer, the quote-unquote resilient consumer, that whole idea, nothing that transpired during the course of last quarter and nothing they're seeing on a forward-looking basis tells you that that is changing at all. And that, I think, speaks to just broad strength across the board. And you don't even really have a housing thing going yet. And housing is 20% of GDP. So if that part kicks in as rates very slowly come down, the 10-year moderates, mortgage rates come down further, if you get that 20% of the economy back into a higher gear, combined with how well everything else is going, I don't see why you'd want to make huge changes. One thing I want to call out here, because we're in earnings season, we all know how important technology company earnings are to the S&P, to the outlook, to sentiment, to multiple, et cetera, et cetera. The tech sector actually has estimates being raised since the start of this earnings season. So as recently as June, the street was looking for 15.9% year-over-year earnings growth for this quarter, and now they're at 20.9%. And that's not in a long period of time. I think they're looking at all these deals being announced, and they're figuring out, oh, this is more revenue for Microsoft. This is more revenue for NVIDIA. And they've had to take those numbers up. And by the way, they've taken Apple's numbers up as well. We don't have those reports right now. We'll get them very soon. But if you've got the financials reporting blockbuster quarters, which is what they've done, and now you get technology companies as the follow-through, why would you look at this market and say, you know what, I want to make a hard pivot and do something totally different than what's working? No one's going to do that.
Right. Carrie, because Malcolm are troubled, if you want to use that, with the multiple. It's not, for the conversations that I've been having of late, and some of them have been with, very important money managers, it's not derailing their overall view. And they'll say, well, okay, yeah, stocks are a little expensive. It's not like there's a lot that's necessarily cheap. But the NASDAQ today, like the multiple of the NASDAQ at its peak back in, early 2000, I don't know what it was off the top of my head, but it wasn't even close to what it is now. Yeah. So there's, in that view, and like the Paul Tudor Jones perspective, you might not love the multiple, but there's a lot of potential runway ahead before you even get close to what they would consider to be crazy town.
Well, I think the big bank CEOs take a cue from Jamie Dimon and try and give us a little bit of telling us to curb our enthusiasm a little bit whenever they deliver these big numbers, especially in record-breaking quarters like we just got done having, right? But I heard the CFO of JP Morgan say, this is the busiest summer I've ever had with respect to deal making in M&A, right? And you guys were just talking about the big banks and the impact that that's had on the rest of the markets. We've had more than 150 IPOs through September so far this year, another 50 or so slated to happen this year. that alone tells you where the appetite and the risk sentiment is for the rest of the market. Everything else, to your point, Scott, is just noise. So investors have been able to look past the shutdown, the tariffs, the everything else, and say, this is a market I still want to be long. It's not a place I want to be looking to get out.
That's why Citadel's Scott Rubner says, talking about conviction among retail traders, it remains extraordinary that demand for call options has outpaced puts for 24 consecutive weeks. That ties with November 23, the longest streak ever. So he points to that. Now, the data only goes back to 2020, but nonetheless, it gives you a pretty good picture about where the bets are being placed in this market. The retail radar from JP Morgan tells a very similar story. Yes, we had an escalation in the trade war with China. You know, the president yesterday says, yeah, we're in one now. And obviously Friday escalated things and it caught the market a little bit by surprise, which is why you got the big sell-off that you did. However, imbalance, if you want to look at it that way, remains, according to the retail radar at JPM, robust. Plus $6.5 billion in terms of money coming in versus money coming out from retail. That already exceeds a strong year-to-date average of 6.4 for a couple consecutive weeks.
We now have these heat checks and these gut check instruments that trade 24/7 in the crypto markets, and it was an absolute slaughterhouse in the crypto markets Friday night into Saturday morning. It's recovered, not all the way since then, but that's where that risk-off appetite was being expressed with all of the publicly traded companies closed in the U.S. and Asia, et cetera. They go to the crypto market for liquidity and maybe to get negative on something, maybe to express a bet. That cycle plays out. That used to take a week. Yeah. We don't even need the stock market to be open to completely play that whole ballet out. And we're in the third act of the ballet by the time it's Monday morning, and Trump is saying, don't worry about China. Yeah. You know, it's amazing, the speed with which we price risk, reprice risk, and then put it back to where it was. And things that used to take a week or a month now only require a couple of hours.
Bitcoin is actually off today, too. Speaking of it, it's back down. Futures are back at 108,000. So we've seen a lot of that recovery on the week now retreat. And just to remind you, too, we still have a lot of cash to get to work. We've trimmed in the main portfolios that discuss the single names all the time. We have 8.5% to go. And we discussed it in the past. I took a cautious approach. This is just taking that step forward. But again, I am surprised. In crypto did fall out pretty sharply, as Josh talked about.
Carrie, I want to find out what these moves, what view they express from you. You trimmed Amazon, Meta, and Alphabet, and here we are a week or so out from earnings. So what makes you want to do those moves before you even hear from these companies?
Most of the reason that we trim them is because they were so large as positions in our portfolios. So these are stocks that we've been overweight for years. And that overweight has expanded and expanded. And when you're running a portfolio that's diversified and you have positions that are close to 10%, I mean, they weren't at 10%, but you're getting it to the 8.5%, 9%. It's prudent to just reduce that when we look at just what's happened with the market, and also earnings growth is likely to slow somewhat. It's still going to be decent, but we've had such enormous gains in earnings over the last few quarters.
You just feel like you're just reducing a little bit of risk?
Yes, exactly.
But do you still expect you're going to hear good things from all these companies,
yes,
and you're just willing to have a little smaller position size than you did?
Yeah, plus if you sell something, you buy something else, and we put the money to work.
Oh, we'll get to that too.
That's why it didn't come out of the market. It went into other names.
I got you. Microsoft named a core holding today at Morgan Stanley. Alphabet target to 288 from 234 at Goldman Sachs. We can look at Meta too. The target goes to 870 at Goldman as well from 830. And of course, Dan Ives is out today. We believe tech stocks will be very strong into year end. Could be up another 10%, for the rest of the year. What do you think about that call?
Look, I think there are beneficiaries of the uptick in CapEx spending, and some of these names we're talking about are very high on the list. One of the things that I thought was interesting were the comments coming from Oracle, their AI World 2025 event. These are some of the things that they talked about, and this goes directly to this mega cap tech trade. They said they delivered over 600 AI agents embedded across all its applications. So you hear a lot about what's the use case, what's the ROI, blah, blah, blah. Oracle is finding ways to save its customers money right now by implementing AI. I think this feeds into the low firing, low hiring employment situation. They also talked about specific customers where they're doing things like 70% reduction in manual tasks for financial crime investigation. Like, it's not a story about like blockchain, like maybe someday we'll use these things. Companies are spending money now because they think there's an ROI now or like in the near future. And so if you're worried about earnings season or you're worried about valuations, the number one thing is, will the numbers come through? And so on these stocks, I don't disagree with Carrie. If they've become outsized positions in people's portfolios, you have a job to do. You're a professional. It would be nice to be able to own a max position in every one of these stocks, but it's not realistic. Number one, there are other things you want to invest in. And number two, you're expanding, you're just pushing the chips out and taking more risk if you never sell anything. So I like what she's saying, but I do think these earnings are going to come through because the spending has not stopped. I'll tell you when I hear that it stopped. It just hasn't. And that's what I think the story is that we're going to hear from these companies in a week or so.
Well, I mean, the efficiencies, the productivity that you talk about was a big topic out where I was in Beverly Hills at the CASE Summit, speaking with Robert Smith, obviously one of the kings of the enterprise software industry, who talks about very much the same thing, the introduction of agentic AI and how it is going to be so transformational for these companies, and the way that you're talking about it with Oracle, that we don't even fully understand it yet, but we certainly will, and what it's going to mean for the bottom lines, the profitability of these businesses, which is interesting to me that Josh talks about how much positivity there is behind the stock, and the chart tells its own story. You don't need words to tell you what that chart means for where the stock has gone, yet you're, Malcolm, trimming it today. Tell me more.
Yeah, so this had a lot more to do with how fast the share price has moved in relation to our clients' basis in the stock versus the company itself. So I think, to Josh's point, Oracle's doing a great job of improving the margins of its customers, its core clients. However, the margins Oracle's seeing itself as it leans further and further into this multi-cloud strategy are significantly lesser, or at least reportedly significantly lesser, than that of like an Amazon Web Services or a Google Cloud. And that's a little bit concerning if you consider how much the share price has moved up from about 150 back in April all the way up past 300 recently on all of these announcements, really based on one core client, which is OpenAI. And so OpenAI happens to be $300 billion worth of business for the next 5 years for Oracle. And if they happen to miss on any of those metrics, that's significant. Plus, you have Sam Altman, who's come back to the well multiple times with Microsoft, who is their initial partner in this, and renegotiated terms in one way or another. So if they're likely to do that to Oracle, those margins that Oracle has to play with aren't very good there. So not saying Oracle shouldn't have accepted the business. Obviously, you want to be in business with OpenAI right now. They're the best looking person at the dance. However, for that to be your one key client that's driving everything in the cloud services business, just looked like a great place to be trimming to me, because with the amount of news we've gotten since their earnings about a month ago, it's basically chopped sideways around 300 a share. It hasn't really moved very much on any more of those announcements. And so to me, just looks like a great place to be taking
If there's a software show me story in all of this, a SaaS show me, it's got to be Salesforce, which last check was up on the outlook that they have given towards 2030. There's a stock, and it needed that move. There you see it. Back it back out for me, though, guys, because that tells the better story. You know, this stock is obviously had a decline, and then it's been a sideways mover because it has been, I guess it hasn't yet shown the market what it's looking for to make sure that it is not going to be become obsolete, that software is not going to be killed, that SaaS is not going to be so disrupted by AI that it's going to directly impact this business. You sold this stock at the end of August, beginning of September. So what do you make of the outlook and the broader debate over this name? Because I feel like the debate over software and being killed by AI is so acute around this particular company.
Well, this was a stock that we struggled with, and we have owned Salesforce since we started Aureus, and I was there for the IPO when Benioff came into Fidelity. I don't know, it was 2001, 2. So we know the company well. The benefits from AI and all the spending they're doing, we believe, are more focused on client support and not the whole sales effort, which is what the clients need. They need software for. They need benefits from AI, and we're not seeing that yet. We've had a lot of promise. We've had a lot of discussion from the company about where it's going and what they're going to do and when they're going to see revenue and profit enhancement, and it's been slow. So we just decided to step away and, we'll watch it. We'll watch and see when there's an opportunity.
I think there's a macro cloud hanging over the sales forces of the world where you're looking at the labor market, which is clearly, some would say decelerating, others would say it's literally weakening. It's not like catastrophic, but it does point to lower headcount at large enterprises, not just in the United States, but probably all over the world. It's not that companies are firing everyone, but they're slow to hire because they're not sure how much mileage they can get out of all this AI spend they've been doing, and how many employees that keeps them from having to hire. So if you're a sales force, like, one of the tailwinds for growth is having large enterprises hiring millions of people. Those are new seats or new heads to place the software with. So it's not a Salesforce specific problem, but it's a Dow stock. It's the most visible of the SaaS names, and I think that mentality right now that's out there in the ether is weighing on this name. People don't think there's going to be an expansion in headcount at companies, even if the economy stays good.
For Salesforce, though, it's not just a headcount problem. It's more of a technology and design problem. The fact that AI can do a lot of what Salesforce can do. We use AI in our business literally every single day. And a lot of the tools that are coming that I demo on a regular basis, they're coming for Salesforce's key components. The thing that's really saving them right now is there's an embedded level of trust among large enterprises, banks, hospitals, those guys with a Salesforce that a lot of these upstart AI companies can't really get into yet. So the best case scenario.
If you can write your own tasks and workflows as a smaller mid-sized business in a way that you could not have done 3 years ago because you can't afford $1 million engineer in-house, if AI is going to give your people the ability to work around these large SaaS platforms and write your own programs, that's like literally a sea change in the way we think about purchasing this type of software.
These really weren't private credit stories, and they were mostly an issuer in the public markets. We didn't have any exposure to those two names, and most of our large peers didn't either. I think that as more facts come out, likely they're going to be pretty isolated incidents, what I've read, potentially fraud involved. But I think investors are probably a little bit nervous. Are there more credit problems to come? And I can tell you our portfolios continue to do very well.
So to understand why the private credit industry is on the defensive, just take a look at the stocks of JP Morgan versus Blue Owl in the month following Tricolor's bankruptcy and the subsequent failure of First Brands. And as it became clear that direct lending was a small fraction of the exposure, the stocks rebounded a bit over the last week or so, but as you mentioned, Scott, down today.
Yeah. Leslie, thanks so much for that comprehensive look at what's happening here. I'm feeling you're not going to be finished with your reporting around this issue, which I don't feel like is going to go away anytime soon. You want to just wrap this, Josh, real quick on any thoughts you might have before we go to break?
No, it won't go away because the labor market will continue to soften. The Fed is not in a rush to do 50 basis point rate cuts. And a lot of these loans, we know from reporting at the Financial Times and the Journal and Bloomberg over the last couple of years, there's a lot of competition to make these loans because everyone's raised money and they got to put the money to work or else they have to return it. And nobody wants to return money. You can't bill on money that you return. So what do? Ease the covenants up a little bit. Payment in kind financing, extending loans like this. We know this has been going on and it's an isolated incident until there were 10 of them. Then there's it's 10 isolated incidents? What are we talking about? This cycle has been playing out since the Renaissance. We understand this. It doesn't have to mean the whole world cracks. But one of the problems is, historically, we've looked at things like credit spreads. We've looked at junk bonds. versus investment grade corporates, or we've looked at the spread between the yields on junk bonds versus treasuries. Useless, because interestingly enough, the issuers that make up the HYG, the JNK, they have never been better companies in those buckets. So you're not going to see the cracks there. Historically, that's what we would look at. You're still seeing pretty tight spreads. So I'm looking at the BDCs. There's an ETF, BIZD. This is a VanEck product. It's the VanEck BDC Income ETF. This thing is challenging or hit below the Liberation Day lows. This thing violated the April level. And it pays a pretty high yield, nominally at least. What we know is that dividends will be cut in the BDC space.
They already have. They are being, as we speak.
We also know, on a parallel track, people that have put a lot of money to work in private credit are now asking more questions than they were asking 3 months ago. These lenders might have absolutely nothing to do with First Brands. It doesn't matter. Everyone's got the flashlights out, as you said. And as that plays out, probably more will be revealed. And the best case scenario is we do flush out some of the more loosey-goosey stuff and we clean it up, and the economy doesn't fall apart, and it gives us time, and we don't have to have a crisis. That's the best case scenario. We know what the worst case scenario is because we've seen it. So I think it's too early to ring alarm bells, but this idea of like, no, it's just First Brands. Everything else is cool. Absolutely no way. Remember, I said it.
Yeah, that's why we're looking around. Josh, thank you for that. We'll take a quick break. More committee moves from Bill and Carrie, and Josh's best stocks in the market list as well. We're back after this. And stocks have continued their slide as we were just bumping in with the Dow down about 230. The S&P is negative by about 0.5%. Just to keep you up to date here, we're 30 minutes past the hour of noon. Committee moves. I mentioned we have more. You bought TransDigm.
Yeah.
Bill Baruch. Why?
Yeah, well, we have some cash to get to work, and this is a name that we like long term, and it's been under a lot of pressure this year. August report, gap down. We don't have, we own Palantir, we own Leidos, we have some, some exposure, software, slight defense, but aerospace, we haven't had anything. This gets us into aerospace. We think there's good value as we look out 18 months. Multiple is at 31 is a little high, but it's a little lower than where its average is. So we've leaned into it, and it traded down yesterday. We'll continue to watch it. About a 1.5% position brings our 10% cash hoard down to 8.5%.
Okay, let's do this new buy, Carrie, because it's Roper Technologies.
Yeah.
That's not adding to a position that's fully new.
Correct.
Right? Tell me why,
Correct.
this company. Let's look at it.
So it's a stock that we've watched for a while. It's an industrial, it's a holding company. It's made acquisitions over the year, and it's a company that supplies services. You can say software services, but a variety of services to industries like utilities, government, healthcare, across the board. They, within their verticals, have been growing cash flow in the teens over the last 10 years in each one of them. The stock has come down. There's been fear, a lot of fear about how AI is going to disrupt all of their businesses. We have not seen that happen, and we've been following the company closely. And at this price, which again has come down, and having freed up cash from some of our other positions, we decided to start a new position in Roper.
Okay. Why'd you trim Booking Holdings? You've had that for a long time, haven't you?
Yes. Also, been a great stock for us. It's really been fantastic. And everyone thought, well, after COVID, people were traveling, then they would stop traveling. Meanwhile, the stock has continued to go higher. It hasn't been hurt. We see it as a great platform. We still own it. It's become a big position, just really big, and that was why we decided to trim.
You've sized up positions in CoStar, in Waste Connections, Applied Materials, Wabtec, well, and United Health.
Right,
Well, United Health,
exactly.
you play this run in healthcare?
But we had bought it when it totally collapsed, and the stock has been coming up. We think that it's on track to resume its original growth rate or close to it over the next few years. You see insurance premiums are coming up. CoStar, commercial real estate, is starting to do better. AMAT, it was a small position. We added to it. Wabtec, we've owned it a long time. Again, it gave us an opportunity. The stock came in, and Waste Connection. That's a very, very solid anti-cyclical company. Nothing to do with AI. You got to pick up the trash.
Yeah, there's a few of those out there.
Great company, Wabtec. Yeah, I love that one.
All right, let's get the... All right, we're doing Josh Brown's best stocks in the market, and it is related to this incredible run that we've seen in gold. Let's look at gold as Josh gets his thoughts together for this, because one plays right into the other, right? I mean, the move above 4,000 and what feels like it just doesn't want to stop.
Yeah, so for people that are investing for themselves and not professional investors, they don't have this situation where they can't just buy gold themselves. If you're an equity portfolio manager, you have to use the gold miners to get exposure. And if you did, you're in luck. Today, this is the best year for the gold miners, silver miners, copper miners ever. The metals industry group is up an astounding 91% this year. That almost never happens for any industry group, especially not this one. So what I'm not going to tell you is, here's a dirt cheap stock that you can buy before everyone's ever heard of it. But what I will say, the run is probably not over, because gold, the commodity, had been running way longer than these stocks broke out. So in April, I pitched Newmont as the best stock in the market on the show. Rather than running my fat mouth, I should have just bought it for myself and held it. Newmont is up, I don't know, 60, 70% since then. You can't buy this name right now. It's just way too extended. The one I want to talk about is AngloGold Ashanti instead. It's not as well known. It's $38 billion market cap. There's a special situation here that I think gives it more gas in the tank from these levels, even though it's been up a lot, and I want to tell you about it. Number one, historically, this has been a very inconsistent business in terms of how much of their money they've paid out as a dividend to shareholders. In February, they told the street, we're going to now pay out 50% of net income, of 50 cents as a baseline out of our net income. And then we're going to have this variable, but it won't be as variable as it used to be. They're finally giving some clarity on what that return, capital return to shareholders will be. And obviously, shareholders liked it. The other thing they did a couple of years ago was they moved their domicile from Johannesburg to the UK, and it took them 2 years, but finally this summer, the Russell indices added them officially. So they're in the Russell indices, and that, I think, has opened up the world to institutions to invest directly into the company. So this has lagged the other names in terms of investor appetite, and I still think it's early enough that there's some gas in the tank. I would tell you the 50-day has been extraordinary support since the stock broke out in August. I would be trailing this with a stop loss at the 50-day. It's about 15, 16% of risk. For a name that easily can go to 100 if you think gold is going to 5,000, which now seems to be like a magnet dragging the price of the metal up there, I wouldn't say it's going to happen tomorrow. So if you need to own an equity and not gold, I think this one has more room than Newmont and some of the other names that are larger and more well-known.
Both Newmont and Anglo, record highs today, worth noting as you look at the charts and the nice gains you're seeing. And Bill, you own Newmont.
Yeah, we own Newmont. And I'll say for Ashanti, great regional footprint. A lot of these names obviously run a time. Newmont's made really timely acquisitions, and a lot of the names, like a Coeur, they've made a lot of great acquisitions over the last year, especially in the back end of last year, that have played out to really give them, well-revenue, well-deserved moves this year. What I would say is backing up the truck, just kind of looking at this in general. Not only are gold prices higher, energy prices are lower as well. Their input costs are lower. So these things are going to be free cash flow juggernauts, I think, over the long term. I think this is the early stages, maybe the first quarter of a cycle move here. So I think there's a long runway. You still don't need to chase it, but I don't know how much the pullback is going to be.
First quarter, they put up a lot of points in the first quarter. See if they can hold that.
Ideally, you want to buy on a pullback, and I think people should. I don't think people should just look at a stock that's up huge over the last 3 days and say, I'm going to bet there's a fourth day. I think you buy these names when they're red, when gold pulls back. If you're bullish on the space from an intermediate or long term, that's the way to do it. The problem is these stocks are not letting you in.
All right. Okay, we want to continue to follow the story of the 10-year yield, which is below 4% for the first time since April. If there's a way to back that chart out to show it, one would have to believe it was around the Liberation Day low period. Whether it was on the day itself, I'm not clear, but you can clearly see the move lower, if we can look at it that way. And what you guys think of. The 2-year, by the way, is the lowest since 2022. So show the 2-year yield as well, guys, as the market anticipates rate cuts furthermore from the Fed, which is why the 2-year would obviously be moving lower. As some suggest, it's the Fed follows the 2-year, not the other way around. So I'm wondering how you guys are thinking about this move, Josh, in yields and what it might mean for stocks.
I mean, it's like one day, so I don't want to make too much of it, but just for people that aren't fully understanding why we talk about bonds on the show when we're usually here to talk about stocks, it's another way of gauging risk appetite. And when yields are falling, that's because people are buying bonds. And why would they be buying bonds? Sometimes risk off, sometimes asset allocation. So I think on a day like today, when you have banks like Zions and Western Alliance, and you've got some concern in the financial sector, and then you see that coincide with falling yields, people get nervous, and that's why we're talking about it. But if we see yields falling for 10 days, that's different than that. So I don't want to start.
No, I know you don't need. You don't need to do that. Right. But it's noteworthy in and of itself.
I agree,
First time since April. You're below the 4% threshold. The stocks we talked about earlier, some of the private credit-related names, alts managers, private equity, the ones who are sort of all inclusive in some respects.
That's more notable to me.
Yeah.
Is the share price of the private equity and private credit giants. These are very well-run companies. Nothing's on fire, but they can't catch a bid. They can't catch a bid despite all the positive comments from their non-alternative cousins, J.P. Morgan, Goldman Sachs, BlackRock. It's a little strange.
Yeah, I mean, do you own Carlyle or KKR?
I own CG Carlyle.
Okay, so you got Carlyle, but it's KKR is down almost 4%. Blue Owl, which we were showing you, down 3.5%. Ares is off about 3%. Apollo's about 3%. Malcolm, you have thoughts on what we've been talking about in nearly every show for the better part of a week or so, and Leslie Picker's been helping us follow the money there. But this is an interesting story as it has, moved into other areas of the market too, like the regional banks that Leslie was reporting on as well.
Yeah, I own Carlyle personally. I own Blackstone personally. I think there's a ton of embedded deal premiums in those funds that once they finally get a chance to transact will be realized and be valuable. The management fees that those guys collect are astronomical, and that's what really matters. But I think the fear over private credit can't be overblown when you consider just how many payments in kind loans there are buried underneath the surface, which is basically an agreement between the lender and the borrower that instead of us collecting our interest and principal the way we normally would, we'll just make you a new loan to cover the interest and principal for some time. That is on the rise. It's the highest level it's been since 2021, and I think we're finally starting to see those cracks, to keep using that word, that are forming. And
we're always in a react first, ask questions second kind of a marketplace anyway. And when you start talking about the bond market and credit, which is obviously much deeper than the stock market is, people just have PTSD as well through prior periods of extreme volatility, crises,
well, sometimes the smoke is fire. We had, it's a little over 2 years ago, we had multiple banks go to zero.
Regional banks this week, they're having some volatility as well.
Signature Bank,
yeah.
Like it existed, it was a thing.
Well,
and then,
First Republic.
And then the next day it was not a thing.
Yeah.
First Republic, like
Silicon
it's not
Valley before that.
Silicon Valley. It's not always just smoke.
Yeah.
And I think rationally, people are looking at that and they're asking questions now, and maybe they'll get satisfactory answers to those questions, and this will blow over.
We've also been predicting the end of private credit for a while now, so maybe it's not the thing that ultimately ends up being the fire. It's somewhere else we're not looking
regional
right
banks,
now.
subprime auto loans, and then Philly Fed manufacturing. We don't have any economic data coming out. That was a pretty big miss this morning. That was a little bit of a heartbeat on where is the economy right now with the government shutdown going on. Not to mention, the government is shut down.
We'll get a good read.
Bonds.
I'm sorry to interrupt you. We'll get a good read at 3 o'clock this afternoon. Schwab's Liz Ann Saunders among those who will be with me then. Mohamed El-Arian is going to be around too, and he'll be here on set. So we'll have a good conversation about all things markets coming up. You want to give me a final?
Yeah, Goldman Sachs. Go with that one.
Okay.
Buy the dip here.
Microsoft earnings in a couple of weeks, better improved margins.
Okay. Who's got Schwab? Is that
I've got
Karen?
Schwab.
All right.
Yeah, had a really strong quarter, added a
Trying to front run Liz Ann Saunders' appearance?
No, love Liz Ann. She works for them. She could talk about anything. $13 trillion in assets, and they keep growing.
Okay, good stuff. Josh Brown.
Toast, green on my screen.
Okay. There is still some green on the screen, mind you, but obviously the market picture looks a little bit differently. Information technology as a group is still green, as is healthcare, but we'll see what happens when I see it 3.
Well, welcome to the second segment of this video. What we're going to do is cover the stocks, a number of those stocks that were talked about on today's halftime report. We just saw Josh Brown and guests share some of their stock picks, and we're going to look at those stocks in a few moments. But first, let's talk about what's going on here in the indices. What happened? It's Thursday, October 16th. It's 5:45 p.m. The market is closed, and here's what's going on. You can see at around 11:30 a.m. the market was going pretty steady, and then it dropped. Right? We had a little drop here in the Dow Jones. We moved up slightly. We created a lower high from the prior high, and then another lower high. So that's not positive. So we basically, we were in a downfall here, down 0.65%. It looks like it stalled here between 2 and 4 p.m. So there's a slight chance tomorrow that we might see a pop-up, but, this is bearish. NASDAQ down 0.47%, right? Same thing around noon or so. Price closed on this candle here under the prior day's closing price, and then it stayed under it. So that dotted red line that you see right there, okay, that's yesterday's closing price. Basically, we came back up to it and dropped. So this too looks pretty bearish. Now, towards the end of the day, you can see between 2 p.m. and 3 p.m. we have this higher low right here from the prior one. So, but the question is, will we be able to break through this little area? I don't know. We'll see about that tomorrow. S&P 500 also dropped around to, I would say 11:30 or so, down 0.63%, creating this lower high there, lower low here from that prior low. And so also same situation, we're going to see if it can break through this ascending triangle type pattern tomorrow. Russell 2000, it just started dropping immediately, right? This is where yesterday's closing price was. You can see the second candle there. It dropped, right, and moved up slightly, dropped some more, down 2.11%. Look, the Russell 2000, the small and mid cap stocks are going to get impacted the most from what's going on right now with the shutdown, and there's a whole array of issues out there in the markets. And the financials, well, let's take a look what happened in the financials today. All right, look at the red. Okay, look at this. Hold on, let me just show you guys the financial sector. That's what the financial sector looked like today. That is not good. Nvidia was up though, 1.1. A lot of the semiconductor stocks did well, based on Micron, up 5.52%. By the way, this was one of the stocks that I recommended to my members in this last weekend's video. Oracle was also up 3.09%. You can see a lot of the technology stocks like Apple was down, Microsoft down, Amazon, Tesla down, Walmart and Costco down quite a bit. Costco down 3%, Walmart down 2.35%. The oil and gas stocks didn't do so well today. So yeah, not a really good day overall. And if we look at the groups here, we can actually see what, this in relation to the sectors, which ones were up today. Was just basic materials and healthcare. That's it. Everything else down, and the financials down the most, down 2.4%, followed by energy down 1.17%, and then utilities down 0.81%. This is the 1 week performance though. So basic materials, you can see here at the top, then utilities, consumer defensives, and real estate. Everything else, including technology, down for the week, down 2.41%. Here's the 1 month performance. So still for the 1 month performance, technology is up 4.38%, but utilities has had the biggest lead here. All right, let's take a look at the stocks now, guys. We're going to start off first with the index ETFs, like the SPY, the QQQ, the Dow, the Russell. We're going to look at the VIX too. And then check out how many stocks we've got listed here. We've got 28 stocks. I'm not covering every single one of the stocks they talked about, but I'm covering a good portion. And guess what? Out of those 28, I've already reviewed them. It's just 5 out of the 28 that actually look sound technically on both the weekly and the daily time frame. How am I determining this? I'm using the Ichimoku indicator, and I'll get into that in a second. Then you've got the Mag 7. Well, I'm going to cover Tesla, Apple, Meta. You can see that they were all down today. We're going to look at the strongest sectors that I've got highlighted here with a blue flag. All right, the rest of them not so great. And then we've got some requests from our members. So I'm going to take a look at these stocks as well. So, yeah, let's get started here. Let's look at the start off with actually one of the ETFs here. One out of these ETFs that's actually doing pretty well. And I mentioned this before. I said, as long as the shutdown is happening, there's a high probability that people are going to start looking for other places to invest. And it just makes sense. The Euro stocks, 50. Here's the FEZ is the ticker symbol. This represents 50 top stocks within Europe. And this one was up 0.90% today, almost 1%. What do I like about it? Well, if we look at the indicator, it's called Ichimoku. And this is how you can quickly determine what's, if the stock is strong, what you're looking for is that candle, that last candle there, which is today's price. We want that to be above the 2 moving averages. We want it to be above the 9 period. We want it to be above the 26 period. All right. We want the 9 period to be above the 26 period. That green line to be above the red line always. We want price to be above both and above the Ichimoku cloud, and ideally above the 200-day moving average that you see right there, that dotted yellow line. All right. Finally, the last part of the indicator here is the Chiku span, and that is basically today's closing price. If I just draw a line straight back 26 periods into the past, that's where you'll find that. So this is the closing price in a line form. It's projected 26 periods into the past. Why? So we can look at to see where that is in relation to the candle 26 periods ago. If it's above it, it's bullish. We're bullish, right? We also want the Senko span A, which is the light colored blue line here, to be above the Senko span B. And this projects into the future. It's derived from taking the midpoint of the 2 moving averages, projecting at 26 periods into the future. And the purple line is taking the highs and lows divided by 2 of the last 52 periods, in this case 52 days, and projecting that instead of under the price 26 periods into the future. So it's a very basically succinct and comprehensive indicator because it can show us the strength of the trend. It can also show us where we might find support, where we might find resistance, depending on where the price is in relation to the moving averages. All right. I've also have the directional movement index down below here. We want that green line to be above the red line like it is in this case. So you can see this is the directional movement index. I've got it at a setting of 9, and the ADX is also superimposed. That's the white line. We want that white line. Ideally, you want that white line to be moving up instead of sideways like it is right here, while the green line is above the red line. All right, that what the white line represents is momentum, and if that's increasing, that means that the momentum is going to also increase to the upside. Here's an example. See over here where the white line was moving sideways. Let me just make this a little bit more easy to see. So you can see here it was in fact going kind of down right there, right, and then it started to pick up. So around that point, if you go straight up, okay, you can see how price also moved up as a result. Here's another example. All right, let me just show you that one too. Here it was going down. Over here, it started moving up on that candle, and then you can see that price did in fact move up. It can be short-lived, and then once it starts to lose its mojo right here, it starts to drop. Okay, basically, price can also drop. All right, so that's what you have to watch out for. Over here, for example, ADX was moving up. You start seeing it drop. That means the momentum is declining. You go straight up, and you can see that led to a drop too. You can also use the positive DI9. If you see that that's going straight up, and then that gives a sharp decline like it did right there, that might even give you a faster signal. All right, do you see what I'm talking about? And the opposite applies here. So if the red line is above the green line, we're in a downward trend. If that starts to drop and you go straight up, you'll notice that can lead to a move up. Very interesting. So yeah, it's a very, overall it's a relatively simple indicator. And then we've got the volume below here, and that's going to give us some insights as well. But FEZ looks good to me. I like it on the daily chart, and I like it on the weekly chart. So it gets a blue flag today. Everything else does not, though. So let's look at that. Let's look at SPY. SPY, which is the S&P 500, still looking strong. Prices above the Tengen-sen and Kijun-sen. Those are the names for these moving averages. But on the daily chart, as you can see, it's struggling here. What is forming is almost like a pennant type formation. Do you see what I'm talking about right here? Like a symmetrical triangle almost. And so the question is, price is getting squeezed into this little area here. And so the question is, where's it going to pop? Is it going to pop up to the upside or to the downside? All of that is dependent on the news, really. No one can really predict it, okay? So we've got to observe how price reacts to the news. And sometimes it's like, it doesn't really make a lot of sense, right? Why price is moving up, obviously, because you can have a lot of negative news and then the stock market's still going up. But the bottom line is the chart is going to tell us, it tells us a story. It's going to certainly give us some insight on where we are heading. And right now it looks we're just kind of stuck. Remember, it was this red candle here from Friday. I'm sure you guys remember October 10th, where price dropped under both of the moving averages. And that happened on big volume here. That's kind of scary when that happens. Why? Because it means that there's a lot of money coming out, double the volume, a lot of selling that took place here. All right, because of the that was more related to the Chinese tariff situation, right? And then, so right now I think the market is undecided. So as long as it stays within this candle here, that's what I'd be watching to see. Where is it going to go? Is it going to get under? And then that could precipitate down to and drop further, or will it get above? And then we'll see an expansion to the upside. We shall see. All right. So here's the QQQ ETF. That was SPY. Here's the Qs. Same situation, right? Exactly same situation. Here we get that triangle going on. So there's really indecision here. The Dow Jones. Now this one looks a little bit more bearish, honestly, because here we did have that drop, and then price popped a little bit here, and now it's dropping again. And the other problem that I see here with the Dow, take a look at the moving averages, guys. The green line has crossed under the red line. Remember I said earlier, we want that green line above the red line. Why? Because it's the faster moving average. When the faster one is moving under and crosses under, and then you also happen to look down below and notice that the volume is increasing, meaning there's more participants involved in this, right? Today, down 0.68%. And then also look at the directional movement index. That's also not looking good. Negative DI is above positive DI. So that's all bad stuff happening right there. Russell 2000. I'm afraid to look at this one, down 2.11. All right, so it doesn't look as bad, right? Because it was a big drop. And it did happen on high volume, but it did stall. It stalled right at the moving averages. And the Tengen-sen is still above Kijun-sen. All right, so, but I'd be really cautious here with this one too. I think the Dow looks even worse. You can see that we've got in fact, we even have a lower high over here from this high. So you can see that decline right there. We don't have that yet in the Russell. All right. We are still technically, you can see that high and that high. We've got ourselves a little bit of an up channel going on here in the Russell. So we'll see what happens, right? But here's the thing that's causing a lot of, also the VIX represents fear. Take a look at the VIX today, up 22.63%. That's a huge jump. Now I started saying we got to start watching and being careful here. When volatility starts to increase at these levels, and it all starts with just that one first candle, right? And yeah, you can see here things subsided for 1, 2, 3 days, and then boom, it's now more volatility. Volatility is not good because it represents fear. And so here, where we were obviously stuck in a nice consolidation area for quite a while, look at that. That's multiple months between mid-May or so, and today. We were in these levels here. The second we got above the Ichimoku cloud, in this case, it's not a good thing, right? Because again, we want this to be declining. And look at that, ADX going straight up. This is what I'm talking about. This is we should be very concerned here with the VIX moving the way it is. What happened last time that the VIX jumped like that? Well, all we need to do is go back to April. The last time that occurred was back here on March 28th, actually. Let me just zoom in a little bit. Let's go back in time for historical purposes here. Right here. See this date? That happened on March 28th. That was actually before the big jump, all right, in April. So isn't that interesting that the Ichimoku cloud gave us a little bit of insight? And it could have been because, you know what? The big players, they know exactly what's happening at all times. So here we could see the VIX was dropping, and then it started to pop a little bit here. The positive DI crossed above the negative DI right there on that same exact candle when it got above the cloud. And then that led to a big jump here of approximately 177% in just 10 days. That's huge. And of course, the market also dropped significantly during that time, right? So I've showed this to you guys before multiple times, but yeah, we had that big drop there. Here was March 28th, right there, that candle right there. Okay. So what do we do now? Well, we got to just observe and see what happens. Are we going to get more volatility, or are things going to slow down a little bit? I don't know. We'll find out. We'll find out tomorrow. But I certainly wouldn't be adding crazy amounts of stocks to your portfolio at this particular time, because if this does continue and the market drops to the downside, that could be the end of this long trend that we've had, potentially. Now, remember, if we look again at the S&P 500, the SPY, which is really a good bellwether, right? That's what we want to look at. On the weekly chart, we are still holding up above the 9 period, and that's really important. If we get under the 9 period on the weekly with the SPY by tomorrow, that's going to be big trouble, I think, going into next week. We're talking about the next level of support is this, the Kijinsen, the 26 period. That's about 11.69% away from where we currently are. All right, so just keep that in mind. All right, let's keep going now. We're going to look at the stocks that they talked about on the show. AMATs, like I said, some of these, there was just 5 stocks really that were looking pretty good. So here's the weekly chart on Applied Materials. You can see that this is exactly what we want. We want price to be above the cloud. The Senkou Span A is above the Senkou Span B. ADX is moving up. Everything looks pretty good here on the weekly. On the daily, it was only up 0.06%. But even these strong stocks, if the entire market starts dropping, these will be impacted as well, most likely. So just keep that in mind. What might not be impacted is something like this, gold. Because gold has been on a tear, all year, basically. And, just look at it from January back here. It's up 233%, this particular stock, Anglo Gold Ashanti Limited. But, when there's fear in the markets, this is where people go. If there's concern about where we are heading with the economy, this is obviously, this is obviously where people want to put their money. And don't forget, it's really gold that's going to be, I think, the strongest, one of the strongest places to be invested, probably for the rest of this year and maybe into next year, honestly, because I think there's a lot of fear in, especially, foreign countries investing in the U.S. dollar at this particular time. That's where we're at. Okay, so AU, I like AU. That looks great. Morgan Stanley, this one technically, it is above the moving averages here. But the Tenkan and Kijinsen are at the exact same level, and it did stall there today. It was down 1.62%. The Chikou Span here is still above price, which is good. The cloud is bullish on the daily, and it also looks good on the weekly chart. But remember, the financials today took a hit. And then here's a shooting star that gave us a little warning yesterday, right? But it held up pretty well. So hopefully this can turn around. Then you got NEM, another gold stock that they talked about. Look at this one. Isn't that a beauty? Let's go back in time. let's go back to where it popped above the cloud, right about that, right around there. That happened back in February of 2025. And it's up 103.39% since then. What did it look like when it was under the cloud in the past, though? So you can see over here when things started getting, it was had a nice high up here of around 58.90, and then we had this big gap down, right? Gap down there in the stock. It dropped. So remember, what goes up can eventually also come down, and when it does, it changes the whole, basically, potential for that stock. Over here, you can see that big red candle enter the cloud. In fact, it looks like, the very next day it got underneath there and continued to drop. So from that high to that low, it was about a 36% drop in about 2.3 months. So, but right now we're doing pretty good here. I like what I'm seeing so far still. It looks like it's getting a little toppy. I'm not going to lie. It's getting a little bit far away from the moving averages here. Let's hope that it can keep going, though. WFC, Wells Fargo and Company, is another financial sector bank, global banks stock. And basically, we've got a bearish engulfing pattern right now. So you can see that right here between these two stocks. I'm sorry, these two candles. The larger red candle is engulfing the smaller bullish candle. That's bearish. Okay, down 2.85%. Still holding up above the moving averages, though. So maybe as long as we can hold up above these levels, I think we're still good with Wells Fargo. The rest of these stocks don't look great. I'm not going to lie. I've already reviewed them. So let's take a look at them. And I'm not going to spend too much time because if price is either under the moving average or under the cloud, it's something I just completely just skip. I don't even consider adding a position in that scenario. It just doesn't make any sense to me. So we're not going to need to spend too much time on these, all right? So APO, you can see how everything started to fall apart. Actually, it started falling apart right around this area here. Like price got under the Tenkan there, moved up slightly, then got back under it. And since that point, it's dropped about 19.8%. All right, so it's been moving up. You see the negative crossover. Remember I mentioned that earlier, the green line crossing under the red line. That's a bad sign right there. Stayed under. Tried to recover here. Where did it stall? At the top of the cloud, which, by the way, all right, coincided with the 200-day moving average, which was declining at the time, and dropped. Boom. Moved up slightly and now dropping again. It's hard to pick bottoms. Hard to pick it. Now you might say, oh, it's gotten cheap. This is a cheap stock. I should be buying it here. How do you know it's not going to continue dropping? You don't. That's my point. Over here, you can see that we had multiple candles under the cloud. And once we had that negative crossover here, it dropped approximately 37% in 3.6 months. Do you really want to be holding on to a stock that's dropping when you're also missing out on opportunity cost? It's an opportunity cost situation. You could be putting your money into something stronger that's actually moving up versus declining. ARES is another one I wouldn't be getting into. It's also in the financial services sector. You can see it's also in a decline right here under the cloud. BIZD, same thing. BKNG Booking Holdings also under the cloud and under the 200-day. Doesn't look healthy to me. BX also came up, retested the cloud and dropped. Finding support at the 200. Maybe it will bounce, but I'm not going to take a chance on that. Citigroup is still above the cloud, so that's positive, but it's starting to show signs of weakness here. The Tenkan has crossed under the Kijun, and it is still finding support at the cloud. So it's got potential to rebound again, but I wouldn't be jumping into it. You got yourself, Carlyle Group was down 4% today. This is its first day under the cloud. In a long time, by the way. In a long time. Go back in time. When was the last time we were under the cloud? It was back here, May 9th of 2025. Okay? So that's a long time ago. And so there's a lot of weakness here. CRM, also, you don't want to be adding positions when you're inside the cloud. That shows indecision there too. There's the daily chart, and here's the weekly. Very bearish still. Finding support at that 200-day, but still very weak. CSGP also declining. GS, Goldman Sachs, is we got a negative crossover right there. I'd stay out of that one. You can see the Chico span's showing weakness too. That white line got under the candle. Do you see that? Where it was bullish before, now we've got another bearish signal. So we've got one bearish signal, two bearish signals. How about the future cloud? The future cloud is still bullish. What about another bearish signal? I see I'm looking down here. I see the negative DI. The negative DI9 is above the positive DI. And if you look right here, the white line started moving up right around there. Okay. So I'd stay out of Goldman Sachs for now. HYG, also not looking great here. You can see that negative DI is above positive DI. Candles inside the cloud. JP Morgan finding some support at the top of the cloud, but look at that, rising ADX, and the negative DI is moving up, positive DI moving down. Overall, it's still technically sound. Why do I say that? Because it is, we get a higher high here from the prior one. All right, and this high, so you can see that rising trend, and we're still above this low, but we came down to it just a few days ago on Tuesday. We came right down to that low. It bounced off of it. Can it continue? I don't know. It doesn't look that bullish to me, though. I'd stay out of that one, too. KBE down 5.42%. This is now an ETF. The Spider S&P Bank. This is not just one bank. This is multiple banks. Over here, there's a component list I can open up. Here's a number of the banks that are within it. Look at all those negative numbers there. Here's some ticker symbols. You can go through. There's about 89 in there right now. It's not looking good. Oh, there's one silver lining, TFIN. Let's look at that one. Okay, it had a nice update, but if you look at it, it got stuck at the Kijinsen there and dropped again towards the end of the day. Here's a 5-minute chart that shows you that. So reached that level and then dropped. Okay, let's look at another one, KKR. Oh my goodness, I'm sorry, that's a 5-minute chart. That does not look pretty. Down 5.58%. Here's a daily chart. Under the cloud, no. KRE, no. Okay, this is another regional banking ETF. Financials not looking good. Owl, they talked about Blue Owl Capital, also under the cloud now for a while. You can see it came up, tested that 200-day, dropped. Okay. No thanks. I mean, from these highs here, we're down about 40%. 40.6% from the highs back in early 2025, earlier this year. ROP, also down quite a bit. It's dropped about 15.9%. That's Roper Technology. SCHW, Charles Schwab, under the cloud. It pierced it today and then dropped again. So it showed a little bit of strength. You can see the 5-minute on a 5-minute chart with that big jump in the morning, and then they just dropped along with the rest of them. The whole sector. TDG is industrial sector, aerospace and defense. That one also under the cloud. Here's Toast. Josh Brown likes this one. Or he's liked in the past. I forget what he said about it. But basically, you can see it's in a decline. All right, stay out of that one too, folks. Notice how the cloud is negative here. The Senko Span A is under the Senko Span B, the light colored blue line. That's also bearish. UNH. On the daily chart, it's above the Ichimoku cloud, in between the two moving averages. On the weekly chart, it's not. It's bearish. So it does make sense to look at both time frames before you make a decision about a stock, in my opinion. I want to see a stock that's strong on both a weekly and daily when it comes to the technicals. All right, the fundamentals are important too, but if you don't also have the technicals confirming your purchase, you're in trouble, I think. I've had more negative experiences buying stocks purely based on fundamentals than on technicals. Technicals have done for me way better in my trading, significantly better over the years. And I've been trading since I was in my 20s. Okay. WAB, Westinghouse Air Brake Technologies Corporation. This one here is, let's see here. The weekly chart, is it? 193.61. It's slightly above the Tenkan-sen on the weekly. On the daily chart, it's inside the cloud, so no. And then WCN is also, look at that declining trend here. I mean, from the highs back in April, it's dropped about 15.3%. All right, so that's all the stocks, the majority of them that they talked about. Tesla, here it is in the daily chart. Yesterday it popped above the Tenkan, and today dropped right back under. Here's the weekly chart. So the weekly chart still looks pretty bullish for Tesla. The problem is we're really close to these levels here. The prior high of about 4. I mean, you might say that's pretty close, but it's about 12.5. What is that? Yeah, or a little over 12% away from that high. So that's what I'd be watching. Let me make sure I get the right price. 488.54. Okay. Actually, you know what? I just realized I probably already have that line there. I switched out to, see the boards over here? Yep. I already had notes on this. Okay. So, yeah, basically, October 2nd, I think I had something about a bearish engulfing pattern. Okay. Bottom line is I would, oh yeah, this right here. October 2nd, the bearish engulfing pattern. Look at that. See how it led to that decline right there? Apple. Let's look at Apple. Apple is in between the two moving averages. On the weekly chart, it's above the cloud and everything else, but it's stalling around this 260 level and 250 level. So I'd stay out of Apple for now. Meta also has been declining. It's on the weekly chart. It's under the Tenkan-sen, the 9 period for 3 weeks now. And on the daily chart, we're under the cloud for Meta. It's a no on Meta. All right, let's look at the, I think I'm just going to look into the strongest sectors today because there's so much stuff that I need to cover. GDXJ, market vector. So this is the junior gold miners ETF. Look at this one taking off here, up 2.97%. That's the daily chart. Here's the weekly. I was a little concerned about this candle last week. You know, whenever you get after a succession, all these bullish candles, you get one negative one, and you're like, ooh, that's kind of scary. Especially since I think I drew that trend line, that 105.24. Maybe I drew this after the fact. I think I drew it based on that high. Let's see. Yeah, I drew this trend line based on the high of this reversal candle. I said if price got above it, this thing is still moving to the upside. And it is. So the daily chart looks good. This is 2 days in a row now that it's holding up above 105.24. That's a good support level, though. All right. GLD, gold, also on a run, up 2.34%. Volume is increasing. ADX is moving up. All the things we want to see. Silver, also moving up. Not as much positive momentum. It looks like it might be increasing slightly right now, but gold looks a little stronger, honestly. SMH, this is the semiconductors space, right? So you can see we're stuck in this range here. Interesting. So not as bullish on semiconductors as I am on these 3 ETFs. What about utilities? Utilities looks pretty strong, but today is the first day where we got ourselves a bearish engulfing pattern. Okay, higher negative volume, down 1.09%. I closed out of some of my utility stocks because they've had a nice run today, and you can find out about that, by the way, by becoming a member. So you can, if you want to follow along with the stocks that are in my portfolio, how do you do that? Let me show you guys real quick. Go to my Blue Cloud Trading YouTube channel page here, right? This is one of the most recent member-only videos that I posted 3 days ago, where I went into the entire portfolio. Okay, lots of stocks, and let me tell you about the 3 different membership options. Okay, number one, before I tell you about that, if you haven't subscribed yet, you got to do that. That's really important. It's free, and I'll pop up in your subscriptions. You can also hit the notification bell then, so that you get notified when a new video pops up. Now, once you've done that, click the join button if you want to get this paid content. Now, click the join button, and then you can see here, you can actually choose either Blue Cloud Supporter, Blue Cloud Trader, or Blue Cloud Legend. And the difference between the three are the following. Under this level, you can request a stock to be analyzed or an ETF to be analyzed on an upcoming show. Blue Cloud Trader. Okay, under this one here, you can also request stocks to be analyzed in the show. Under this level, this is where you get to see those exclusive member-only videos that I do each weekend, where I go over my entire portfolio, all the trades that I placed throughout the week. Okay, why I added, why I closed out of positions, I go into that. If you want even more information, Blue Cloud Legend, why is this important? Because under this level, you get the exclusive member-only videos. You can request stocks to be analyzed in the show. And then there's some recorded day trading videos for those of you who are into day trading. You can see some of my strategies for day trading. And then also daily trade updates. This is the key thing. So I am sharing my trades every single day before the market closes. Okay? Anytime, usually between 1 and 4 p.m., I'm usually posting the my trades. And basically, once you've become a member, there'll be a new tab that pops up next to posts. So you'll either find them under posts or you'll find them under the membership tab. All right, that's what it will look like. And if you scroll down here, you can see there's multiple videos. So you can go back into the past, see how my trading has been week after week after week. It's been a good year. All right, and so yeah, consider becoming a member, guys. I appreciate you. Now let's get back to the program. Okay, so I'm not going to go into all of these, all right, because maybe I should just kind of skim through them just so you can see how bad they look right now. Copper copper doesn't really look terrible. COPX is pretty good overall. Here's the daily chart and here's the weekly chart, but it's starting to look a little bit toppy up with these reversal candles that are forming here. Bitcoin is certainly down. It's found some support at that 61.31 level from that candle from August 29th. So you can see what happened here with Bitcoin, IBIT. It came to that level back then, came right back then again here on, on this candle here was September 25th and 26th, right? And then that's where we're at again. So the question is, will we bounce off this triple bottom pattern? Maybe. Oil K, this one looks pretty weak. That's the K1 free crude oil strategy ETF. XHB is under the cloud. So the XLB ETF is under the cloud. That's the materials ETF. XLC is under the moving averages. And we had a negative crossover. XLE is under the cloud. Financials, XLF, look at that big red bar, down 2.78. Industrials looks a little better. It's above the cloud, but still under the moving averages. XLK is technology. This one's, these last few days, it's been under the Tenkan-sen, but overall still strong. XLP is under the cloud. Real estate is holding up above the cloud, but doesn't look that great with the moving averages here. Healthcare also, stalling. It was unsuccessful in breaking back above the Tenkan-sen today. XLY finding some support at the cloud, but still under the moving average there. And that's it for that. Now let's take a look at the members' requests. First Solar. Here's a good one, guys. I do like First Solar. Here's the daily chart. And yes, it was down 2.7%. And this is, in fact, a bearish pattern. It's called a bearish harami. It's when you have a large bullish candle followed by a small negative candle. All right, that's bearish. But we are above the Tenkan-sen. We are above the Kijun-sen. They don't always materialize into something negative. So I'd be watching it closely, though. Here's the weekly chart. Still looking good. We even have a positive crossover in the last 3-4 weeks now where the Senko Span A crossed above the Senko Span B. ADX is still moving up. It's had a nice run up here. LAC is another stock. Lithium Americas Corporation. Here it is on the weekly chart. So we've got ourselves a dark cloud cover pattern here. It's when price gaps up and then drops within and closes within the body of the previous candle here. So that is bearish. And then we got ourselves a shooting star. 2 negative patterns in a row. Never a good thing. On the weekly chart, that's the weekly chart we're looking at right there. Let's look at the daily. On the daily, let me go back to the weekly for a second. I just want to show you that the cloud itself the future cloud is bullish still. All right, and the Chico span is still above price, but that declining 200-day is just lingering right above. And then the daily chart, it looks like, it's starting to show some weakness here. Down 21.72. This is a very risky type stock. I wouldn't recommend it to most traders out there. It's more, in my opinion, it's something that I'd probably day trade versus anything else. You can see that 96.8 million shares were traded of this stock today. You can see that right there. Yeah, it's quite a bit. That's quite a bit. And the average is about 44 million. But that's because it's a low-priced stock of around $7.39 per share. All right, so yeah, I wouldn't be buying here. Obviously, LHX, it's under the moving averages, declining still. Yeah, I'd hold off on this one on the daily. Here's the weekly chart showing some weakness. You can see the multiple reversal candles. This is where the candlesticks come into play. You can see that one negative, two negative, three in a row, and then it closed under the Tengen-sen. That's not good. The next level of support is the Kijun-sen. That's about 9.9% away from where we currently are. Right, this is probably, today would have probably been a good day to take some profits if you're profitable in this stock. This is a weekly chart. Actually, back here would have been maybe a better time, right? Obviously, October 9th, if you were up. Let's see. Then we've got ARK, ARKK. This one here was up yesterday, but today dropped 2.93%. This is the daily chart. Looks pretty good overall. The negative DI is above positive DI, though. And this is also going to be affected, right? This is the ARK Innovation ETF. If the markets drop, this one will too. On the weekly chart, looks pretty good overall. VSAT is Viasat Inc., technology sector, communication equipment. On the weekly chart, looks very bullish. All right, we broke above the 200 and have continued to move up. You can see that there was a little bit of consolidation here, and then today it actually popped. Now, it is, if we look at the daily chart though, it did drop 0.90%, but overall it looks pretty good. It looks pretty good overall. Profit margins are negative 13.11% on this one. Let's look at that weekly chart one more time. Okay, so overall, actually, on the weekly chart, it passes the test of Ichimoku. We got the Senko Span A above Senko Span B, price above the moving averages, and Chico Span above price. On the daily chart, same thing. You know what? I forgot to put a little blue flag on there. So this one does get a flag. So VSAT and FSLR looks pretty good on the, out of the bunch. All right, guys. That's going to do it. Wow, there's a long video. Wow, 42 minutes. Once I get started talking, I can't stop sometimes. My bad. But just trying to share as much as I can. I don't want to see anyone getting hurt in these markets. And I'm just trying to share my experiences, what I think is actually happening. And we can see it all in the charts. The charts never lie, right? Maybe some of the pundits, they might say a few little, they might share some information that may or may not be correct, but the charts, the technicals, they can give you some insights that you're not going to get from just watching a TV show. Anyway, have a good rest of the night or day, wherever you are in the world. We've got viewers from everywhere, every country I can think of. So, yeah, thanks for watching, and don't forget to like, subscribe, and I'll catch you in the next one.